Hey, good morning, everyone. After a brief hiatus, so our good friend Ron Burgess could go up and spend some time skiing up in Vail. We're back together again, and today's episode will be featuring Ed. He's going to be talking about partnerships, and he's had a lot of experience with partnerships, what makes them work and what doesn't. So, with that, I'm going to pass the baton on to you, Ed, and give us some insights as to what we can do to make partnerships work.
Well, as in previous sessions, we're talking about ways of adding value. And I believe, in my mind, that partnerships can be a real asset to a company at a certain stage in the company's existence. And it's something to consider. And so to me, partnerships can add significant value if done correctly. And I thought it would be right, first of all, to start off with a definition so everybody's kind of get an idea of what we're talking about in a partnership. It's a formal agreement between two or more individuals who wish to conduct business together, agree on share ownership, capital contributions, profit, risk, and management. So why do partnerships make sense? Well, I feel that it provides a stronger balance sheet. And the stronger your balance sheet is, the greater your survival rate is going to be. It's going to allow you to go through and continue the business through the good times and the bad times. And if you're just relying upon one person, it can be challenging to do so. So having that extra capital, having the extra debt capacity that the partners can get from a bank is really helpful for continuing the business into the future. And it also helps you to be able to focus more on the business by more than one person handling the business. You share talents, expertise, workloads. It can provide a greater work-life balance, which we've talked about many, many times. And one of the challenging things of running a business is that you're in it 24/7 and you never get out of it to be able to recharge your batteries. Well, if you have the right partnership in place, you will have the opportunity to have more downtime, more time for recharging. Also, with more money and greater capacity on the ownership side, you can move faster. You can achieve benefits quicker. We all know some people that are starting businesses from scratch, and they're trying to do it themselves, and it's rather difficult, and it takes a lot longer to get a business up and running that way because you've got one person focusing on everything. It's pretty hard to do. For me personally, it would be very difficult to do everything myself and be able to focus on ways to make the business more profitable. One of the great benefits, if you do it right, and I really recommend that you would consider this, is that you bring in a group of people that you can work with, and they have different expertise. I think 3 CPAs with the same background, I think you're not really adding any capacity at the top on the management side. However, if you get a marketing guy, you get an operations guy, you get a financial person, you can really focus on what you do best and have it all come together in some type of measurable positive result for the company. So I think that's really important. And the 24/7 thing, it's really hard. And I really believe that backup really helps. And again, it's more of a business rather than a salary. And I think that's one of the distinguishing factors. So what makes a successful business partnership? Well, here's a couple of things to think about, and I would like to get both of you guys' opinion of this as we go through these points. But I think you have to start off with a common vision that's forward thinking, and you have to have planning involved. And not everybody's good at that. But you all have to be on the same page, and you have to be pulling the rope in the same direction. Otherwise, there's going to be potential conflict down the road. You have to have mutual respect for one another. You have to value different opinions and expertise. And you really need to have an opportunity for synergy by coming together as a group. You got to enjoy working collaboratively. Not everybody does. I enjoy it. It's been my whole career that way. That's how I've managed to succeed in my career, is being collaborative, but not everybody feels that way. Some people want to do everything themselves.
Well, you're right, and actually the entrepreneur's profile is usually anything but that. Working collaboratively, they want to run things the way they want to run things. Not that they won't listen to other people, and some of them really appreciate other voices, but this is where the sticking point is, and I'm not disagreeing. I think you're right. You need to have that collaborative capability. It's just unfortunate that the average small business owner, they're independent, and that's why they're independent businesses. They want to do it independently, and they don't want people telling them what to do. That is the number one motivation for people going into business.
Yeah,
they don't want anybody telling them what to do. So this is a tough kind of a tough point. It's important to bring up because you're right about it, but it's just tough for people to realize they need to do it.
That's a very good point.
I wanted to add something too, if I could add. Ed and I had a mutual client, and what we found valuable about it is that it was three brothers, and basically when they had the courage to invite us in, it really changed the dynamics of the business, because they discovered we weren't there to tell them what to do. We were there to kind of expedite and help them put together a plan, and it turned out very, very well. But there was initially, like you said, Ron, a lot of resistance to it. Why do we need help? We've been doing this for 20 years. What are they going to bring?
Yeah.
So, I think that's what Ed's talking about, and I agree with him.
And so I think it'd be interesting to kind of push that to one more level, and that is that a partnership may well need a facilitator that's not a partner.
I think that is always very helpful.
Yeah, because they don't have any skin in the game, and whereas partners have a hard time separating their interests with the company's interests. They want to make X amount of money. They need to have send their kid to college. They need a new car. Whatever their individual thing is, then they kind of try to impose that on the company, and that doesn't work in my experience. You've got to treat the business like a business, and your own personal stuff has got to be your own personal stuff. You cannot impose on the business to do that. So,
no, I think if you have to answer to another partner, it helps keep a check and balance on the family interference. Because you have to go to your partner, not to your family, to get approval on what you want to do as a group.
Right.
So I kind of think it could be a benefit there, because most of the partnerships that have been very successful that I've worked with, they have a way of keeping the family interference out of the business.
Yeah.
And we've talked about that in the past when we did the family business series.
Right.
It's really important to distinguish the two, because as we said in conclusion of the family session, is that if you take care of the business will take care of everyone.
Right.
Expectations have to be very clear and documented. There has to be trust, but you have to have controls to make sure that nobody's abusing their authority. You have to have good chemistry, and you all have to really swear on no lawsuits. Because lawsuits will kill everything, and that's not a productive way of resolving a situation, that's for sure.
That would be a case where if things get that tough, having sort of a mediator, there who knows and understands the business and the players, and does not get too close to any of those, in other words, favors any of them, sometimes that might be the way to fix those problems. A lot of folks, again, if you're partners, they don't want anybody coming in, and especially if they're a bad decision maker and they find themselves on losing, then that makes it a little bit tough. But I just think it's a buffer to do that again in this case too.
Yeah, if I can give you an example from a client that I was working with, I was invited him in to come in and look at a business that was a complement to his business. And it was run by a couple of people he knew fairly well. And when it came down to clearly defining expectations, they wanted to divide the business 50-50. And he said, guys, I've watched you run this business now for 20 years. And unless I get 51% in controlling interest, we're not doing this.
Because he didn't trust them. Well, but you see, in a way, what he's saying is, I don't trust you guys. You want me to put some money in and help
Yes.
you. You don't trust each other, and therefore I don't trust you. I mean, I'm not sure that makes for a good partnership there, but
No, that does not
do the
sound like a
business
good
because of
idea.
that.
didn't do the deal. The other guys are going, nah, we don't think you're that good.
Yeah,
Yeah.
and he was.
He was
that
good. Yeah.
Ongoing, straightforward communication is
Yep.
paramount importance. It's like when Ray and I started working together, we had some very straightforward, honest communication back and forth that really helped get the compass aligned properly.
Right, and we're still working together. Imagine that.
Yeah, and establish a relationship, which is obviously one of the key things in any business venture. We talk, you guys talked about the 51%. Well, those voting rights are really important. And the problem is, if someone's got 51% and they're unreasonable, the partnership's not going to work. And that's what Ron was alluding to.
Yeah.
Yeah, you have to have a way of reaching decisions that's fair and equitable. And one person just can't control everything. I wouldn't want any partnership like that. But that's one of the problems you have when you have a minority interest in a company. So you have to make sure that you're being heard and you're being part of the decision-making process, because you're putting money into the company as well. So
well, it's really sorry about that. It's really a kind of a risk, because as partnerships go on and a business becomes successful, people's attitudes change about that business. So, if you've got somebody who might have been reasonable at 51% when things started out and for the first 3 or 4 years, and then pretty soon you're doing millions of dollars in business, and then the 51% guy goes, hey, I make all the important decisions. And it's like, well, yeah, because you've got 51% of the vote. And I'm responsible for the success, therefore I'm going to take more money than you get. I mean, of course, that's exactly what you're saying. You have to have all this stuff agreed on ahead of time, and you have to feel comfortable with it, but you have to be thinking in terms of over time and with success, how people can change. So it's not something that is static at all. And I've had several partnerships, and I've seen people's attitudes change once they see how hard it is, once they see how successful it might be. And they're the same people, but they have a different perspective all of a sudden. So you've got to think long run. How are you going to get out of this thing? What's the value going to be upon exit? And just exactly jumping into your point number 9 there. But that's a tough situation.
Well, if I can share another example that I think might illustrate the point. I was working with a client who had hired a CEO who literally doubled the size of the business. And as the business grew, the owner became more and more disheartened by the fact that the CEO was making more money than he was.
Yeah.
And eventually the guy said, well, why am I here? I mean, because he was putting a cap on his income, because he said, well, I can't have him making more than I am.
Oh, yeah.
Which was a real mistake, because the guy had doubled the business and was onward to doing more.
Yeah. Well, and that's an interesting thing. And again, we're treading on to 9 here, but not only is that valuation important for exit, it's probably important for compensation.
Yes.
How do you
Absolutely.
pay out? And
Yeah.
we've gone through this scenario. We've gone through all these scenarios, but the one I'm thinking of at the moment is where you've got a group of owners that for whatever reason ends up with notes back, notes from the business back to them, and then the business is doing well and they demand their notes. But the people who for whatever reason were not in on that part of the deal and don't have a note are going, wait a minute, this business is not solid enough yet to be able to do repayment on those.
Yeah, right.
So, we've all been in that situation as well. And you end up with these situations that weren't intended to be, but they end up being unfair to a potential person when say a majority of owners demand a certain thing because they just feel like the business is failing, they feel like it's doing really well, and they just want to get paid. So this mutually agreed upon, all of these several things that you've brought up about trust and so forth have to be bigger than getting started. They have to try to include what happens when we're successful and what the voting rights are today and what are they going to be in the future, and can you change those things? It's really hard to do these things and anticipate all the situations.
Well, I think it's really important to note that partnerships don't have to be forever. They can be for a period of time. And if you have an exit plan strategy built into the documentation that you set up front in the process and a way to value the company, partners can go on their merry way, whatever way they want to go.
Yeah.
Because you might be interested in a business for 5 years, and then you may have a different interest, and you'd want to pursue that. So you want to get cashed out of your one business and move on to your new desire.
Yeah.
And you need to have that flexibility. Otherwise, I don't think a partnership's a good thing to do. It's not forever.
Yeah.
Well, and I think a lot of spouses think that if you own part of the company and the spouse that's running the company is no longer participating, that surviving spouse a lot of times thinks that they should be part of the corporation forever, but that's not the way it works.
Yeah.
And Ed, certainly I saw you get a partner out of a business very successfully, by a buyout, and it can work very well, but I think it needs, and like in your case, an outsider to be able to do it, who doesn't, as Ron said, have anything in the game, so he can do it honestly.
I can't think of anything more important to running any family business than having good outside advice.
Yeah.
Whether it's a partnership, sole proprietorship, it doesn't really matter. You need to have that outside perspective.
Yeah.
And so again and again, we keep saying that. Unfortunately, a lot of business owners don't do it. So they're missing a big opportunity, in my opinion.
Yeah, that's the problems that I was just counting up in my head. I've had 6 partnerships, and they all started off wonderfully, and most of them were severed reasonably well. But they end up being severed in either good times or times that are less good, and so that sort of depends on where the pressure is. But I think what I wanted to mention is that if you go into a partnership, which is one of your points earlier, and you're hiring skills, it's really hard to let that person go if you haven't grown big enough to rehire that person.
Yeah, that's a very good point.
So when someone leaves, and I can't remember the exact situation, but one of the folks that I guess somebody I was working with, one of the people wanted to leave, and everybody, the 3 or 4 others looked at him and said, well, wait a minute, if you leave, the whole business collapses. And he's going, well, that's my point. That's why I need more money, because I'm more valuable than the rest of you.
Oh, yeah.
So, that can end up being a problem. And so you're not holding hands, you're chained together.
Hmm,
And, a partnership
that's
should
interesting.
be, you need to go into it less with the idea that you're holding hands to do a collective thing, and more with the attitude of we're going to be changed together, and how do we let this go when it's time?
Right.
So
Yeah.
the thing that we've talked about many times, the thing is that the partners don't have a business until they can be replaced. But when they can be replaced, one of the partners can get thrown out by the others because they're just pissed off at them.
Yeah.
So,
Well,
Oh, it brings up a great story. I got to tell you this. There was a band that was very prominent in the late 60s called Grand Funk Railroad.
oh
yeah.
yeah, yeah.
You probably heard, we used to play a lot of their songs. It was a great band. Well, they had a three-way partnership. It was a S corporation. And the guy that wrote 92% of the songs, the lead singer, sang almost all the songs, got booted out by the other two.
Oh boy.
Wow.
So there you go. There's a great example. You got to be careful, and you have to have all this stuff set up properly, so you're not encumbered like he is. I mean, that was his whole life, and he's
Yeah.
thrown out of
Wow.
the band.
Yeah.
Wow.
So one of the things that, and I'm not sure if this is the right place to bring this up, Ed, but one of the things that occurs to me as we're having this conversation is that there might be a couple of reasons to have a partnership. One of them is for capital. I think that's pretty straightforward. We need X amount of capital. But a lot of times people don't have capital, they bring their talents. But the other reason is for talents,
Yeah.
skills. What can you do that we can, we can all work together to make this work, and other people have skills and other things. So I mean, I think you have to figure out not only how are you going to split the money, the ownership, the money part of it, but how are you going to split the talent part of it? So you have to come up with, or do you come up with some sort of a compensation that rewards the individual partners more like a salary, for things that they do well. So in this particular case, and I don't know if it was about money, it might have been about prestige or having your name first on the marquee, or who knows. But if it was about money, they could have had an arrangement to say, look, you're writing most of the songs. You're obviously the talented one here in terms of songwriting, and you're the lead singer, and you have a unique voice. So we're going to give you bonus on the songs that we sell. You get compensation that way. We'll give you top billing or whatever, because you've earned, you've proven that you've earned that, or we think you're going to be that good. And you'll have to hit some benchmarks in order to be able to maintain that, or things just automatically shift. But I do think it's really important. I mean, and here's another example. You've got somebody who's a really great machinist. I mean, a really talented person, and that's integral to the particular business. And then you've got you've got your numbers people over here, and you say your procedural management person, and so those three partners come together, and so they're all trying to get things started, and so they're taking low salaries. And now the machinist, gets an offer of twice as much money, and for whatever reason, he's disenchanted with it, and he goes, "Hey, I'm leaving. It's obvious that you guys don't appreciate me here." And so you haven't grown the business to the point to where you can afford to pay for that skill properly, and you haven't gotten to the point to where you are big enough to hire somebody at the right price, at the market rate, in order to be able to replace that. Well, that business never really got rolling.
Well, Ed, what is the end of the story, as Paul Harvey used to say? What happened to Grand Funk Railroad?
Well, here's what's going on. Two of the guys that booted out the lead singer hired a new lead singer, and they're touring around under the marquee of Grand Funk Railroad. And the other guy, the lead singer, he's doing his whole thing, his Grand Funk Railroad thing, and he's calling himself the original Grand Funk.
Oh,
Yeah.
wow.
So now we got two Grand Funk railroads performing, but it's not in my opinion, it's not the same for the consumer.
Yeah.
Right.
You guys could be making so much more money by just burying the hatchet and moving on together, because people want to see the original three members of Grand Funk Railroad.
Right. What they need is a promotional guy to occasionally bring them together and just say, look, I'll work out the deal here. If you all take it, then we're gonna do it. You come on, you play your music, and then you leave, and you don't have to see each other, and I'll take care of it for you.
Yeah,
You know,
yeah,
but
that's
let me
so.
let me throw in. That's a wonderful illustration of how powerful a brand is, because I couldn't give you any of the names of those three guys. I
Yeah,
certainly
right. I couldn't either.
know Grand Funk Railroad,
Yeah.
but none of them. And Ed, do you know any of the three names?
So I know all three, but the lead singer is Mark Farner.
Okay.
And the other two, I know their names if I see them, but I can't repeat it right now.
So you've got there's a brand there in Mark Farner. That name is familiar to me too. So there's a brand name. He could go out that way and maybe not do so well. But the interesting thing is the ownership of the brand has to be mutually agreed upon too.
Yeah.
Who gets it if someone leaves?
Well, that's a very good point, Ron.
Does a corporation own that? And any real business person would have trademarked that after such success and made sure that the ownership sat with the corporation or the partnership so that it was really clear. And then you would have had compete contracts. You need to have professional people helping you do these things.
Absolutely. We come right back to that all the time, don't we?
Yeah.
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 I put down some items that you would want to consider if you were considering to set up a partnership. And this would be kind of like a checklist that you could go through and see if it works for you. And a lot of it has to do with the visioning, just like any other corporation or company, the financial support, the clear organization of charts of responsibility, which we talk about with a lot of our clients over and over again, a strategic plan analysis with action plans, utilizing the valuation wheel, dashboards to measure how well you're doing, an effective buy-sell agreement with a valuation agreement associated with that. And bottom line is, if it's not working, transition quickly.
Very good. Yeah.
So, anything you want to say about any of these guys?
Well, yeah, I would say that under common vision, where are you going? Those are, to me, those are mostly strategic marketing questions. And so, all of the marketing stuff we've done, we've really talked about. So what's your market? Who is your target market? What's your product? How are you going to fulfill that? Who are your competitors? And how are you going to compete with them? And developing your niche market. So that's a single line of well, I guess it's the two of them. Where are you going? How are you going to get there? Typically, those are both marketing questions.
Which comes right down to the point. Anytime you start a business, you better have your competitive advantage and your market in mind and who your customers could be. Because if you don't have that right, it doesn't matter how much money you spend, how much hard work you put into the business, you're not going to succeed.
Yeah. No, that's exactly right. And of course that's the big bet, I think. You may, and I think there are a lot of people who have this attitude, and that is we're going to make a big bet, and that's okay. And therefore, let's not do 1C all the way to the bottom until we're sure we can make the big bet and make it work. But it's too late at that point, isn't it?
Right. Well, I think that's why I like what you were saying, Ed, about having clear expectations going in, because if you don't, everybody walks away from a conversation with a very different idea of what that was.
So it comes right back again to the valuation wheel. We haven't looked at this over probably a year or so, but it's still very relevant. How do you drive value? And in any business that you come up with, whether it's a partnership or not a partnership, you should be utilizing these drivers. And I think with a partnership with the division of labor, I think you can be more effective in optimizing the valuation wheel. And that's why I put it on the slide.
Mm-hmm.
Yeah, thank you.
The last thing is the legal structures that are available for a partnership. So a partnership doesn't have to be a corporation, but it can be a partnership, and you fill out Form 1065 for the IRS, and you split your profits at the end of every year. And the problem with this type of a partnership, you have no protection from creditors like you do with a corporation. There's unlimited liability is another way of phrasing it. And that is problematic, I think, more problematic in a partnership than anything else, because all of a sudden you're on the hook for your partner without any controls and limitations. So you got to consider that. But a lot of partnerships are in that format. Another one is an LLC, which is a state structure, and an LLC can be a partnership or it can be a corporation, but it has limited liability associated with it. So it's pretty attractive. And it doesn't require as many corporate meetings to document that you are a legitimate corporation. So that's why an LLC is pretty popular, especially in real estate transactions. And then the last one is corporations. And there's two types, an S Corp, where the profits are distributed at the end of every year. And the owner, the partner, pays his own payroll, his own income tax based upon his personal situation. And then you have a C corporation where you have double taxation. The corporation pays tax and the individual pays tax when they get a dividend. So that's just some of the things to consider. If you're thinking about a partnership, you should figure out what form is corporate form is best for you.
There's that sort of begs the same question that we've been talking about. If you're looking at a subchapter S or a C, one versus the other one, if you have a money person come along and finance your business, you've got, say, the wherewithal, the know-how, the product, the markets, and that's primarily you, but you need investment in order to do that. Then you go out and you find somebody to come in, an angel to come in and throw $1 million towards that. Well, now you've got somebody who has a different personal tax liability than you do. And they're going to be wanting to treat it a little bit differently. Shall we take this big deduction this year? We know it's coming. We could buy equipment next year. My tax burden is too high. And so now you're making decisions based on somebody's tax situation.
Yeah.
There's just another problem.
Well, I'll tell you one thing that's really good about family businesses overall. Most of them are S corporations. And most of an S corporation of family businesses, what they do reinvest back into the business. Very seldom they just take a dividend for themselves. They usually plow it back into the company.
Well, right. And so what can happen there is, and I think those who are listening would be helpful if they recognize that you're going to pay, if you have $1 million company and you make $100,000, then you're going to share that 100,000, whatever your salary is, that's your own burden, but whatever that $100,000 means to those individuals, you're going to have to pay tax on $33,000, right? So now here's the business. It's cash strapped. It's got $33,000 in profit, not cash profit. And if you don't distribute any more than, say, your salary, now individual people have to dig into their pockets and pay for that themselves. That's a rubbing point, because sometimes people, first of all, you're cutting down, taking the minimum necessary, but the company does well. You don't distribute that in cash to your owners, but you now owe an extra you have an extra $33,000 in income, and you owe taxes at your personal rate on that. And so you could have somebody in a high income, say, gee, of that $33,000 in taxes, you cost me an extra $10,000. I don't have it. I've had that happen to me several times. So that, that's part of that rub there with a subchapter S in a corp. If you don't make if you make some money, the corp has to pay, but you don't do any dividends, and therefore you can control that because you don't have to have it. The individual doesn't have to take it. So those are pretty important issues that require somebody with some pretty good tax knowledge, like you, Ed, to be able to help them, make those decisions. But you talk about operating your business, and then you have a successful business, and now if it's really successful, you don't have enough cash.
Yeah.
Right.
And you have to go out and borrow money, or you have to bring in other investors, and they have other personal profile situations. This is complicated stuff.
Yeah.
And so, small business people take this way too lightly, and then they end up getting so distraught over it that they end up making bad decisions because there's so many of these things out there. Ray and I have had kind of an ongoing debate, I guess, over, because he's enthusiastic and optimistic. And so it's like, you can get out there, you can do this. I, on the other hand, after having 6 partnerships, I'm going, this ain't that damned easy.
Yeah.
And you can really destroy people's lives with these situations. I mean, and I mean that literally.
Yeah.
You can have divorces over these things. You can lose a relationship with a sibling. These are all very big deals.
Well, I think that's why I like the 5 Ds, because they are deadly.
They are deadly. Absolutely.
They are deadly. And so probably this conversation should have been at the front, because this is really important. And you shouldn't really get too enthusiastic about spending a lot of time in business unless you've gone through and thought this stuff out. And frankly, there are an awful lot of business owners who have enough grit to try their product and waste some money trying to sell it. But I'm not so sure that there are that many who've got the grit to go through all this stuff first before you actually even get started. And maybe that's the way to ferret these out. And I guess that's my point, Ray, is that if you spend the time and effort to understand the downsides, maybe you don't have so many failures, because you scared people who don't have the grit to go through it, and they don't ever start.
So my question to you, Ron, it took you 6 times to figure this out?
No, I kept doing it because I liked it.
Oh, okay, there you go.
It worked. They worked. And so, and I don't mean to sound too glib about that. Before I really got into business, I had been working for 5 years. I knew the industry. I had already been in the real estate business on my own. Prior to that, I had gotten a degree, and I went back and got a business degree. And I had wonderful mentors for 5 years. That's before I started thinking about businesses. Okay, so I wasn't naive to many. Now, I've learned a lot in 30 years of doing this for other people, and I made a lot of mistakes along the way. But I'm happy to say that all these I still am friendly with every partner that I've ever had.
Yeah,
no, so that's great. So we managed to get through these things over the years, but I considered all the things Ed had here. Well, I can't say point by point by point. I did them all, as a 30-year-old, but I can say that every one of those things is important, and you need to consider it in terms of getting your business going. You have to at least consider this stuff. It takes time.
Yeah,
it takes time to get this stuff thought through and find the right people to be able to engage in it and all of that. And I've had too many clients over the years lose their houses over this stuff.
No, it's deadly. I mean,
it's not to be taken lightly at all. Yeah,
right.
At all.
Well, guys, it's almost 10 o'clock. Ed, do you have anything else you want?
Yeah, I want us just to summarize. I really believe that partnerships can be an effective way of adding value to a corporation. It doesn't have to last forever, which means you need ways of transitioning people in and out of the company at a fair value, which comes right back to the major question that we have with most businesses. Do you have an idea of how to value your business? Do you know what your business is worth?
Wow.
Not by the gas station information that you're getting from your friends. Hey, I heard someone sold this for this.
Yeah.
You gotta have a fair and equitable way that everybody agrees to while they're still on this earth.
Right.
That's right.
Yeah, because you can't take it with you.
You can't take it with you. And when a partner's gone, the other side of their family is going to think that business is worth a lot more than what it really is.
Yeah. Yeah. Well, thank you, gentlemen. As always, it's a pleasure. And with
Good
that,
session,
I guess
Ed.
we can wrap it up.
Sounds good. We'll see you next
Alrighty.
time.
Take care. Bye-bye.
Okay, guys. Another one in the can, as they
Another
say.
one in the can. It's been a while.
Yeah.
What's the next one going to be?
I could do something on, building a strong culture if you guys are open to that.
That's a good one.